A company can have brilliant products, incredible profit margins, and stellar management, but buy at the wrong price and you'll lose a lot of capital. That brings us to Privi Specialty Chemicals, or PRIVISCL. If you check the label on your shampoo, soap, or laundry detergent today, there is a very high probability they manufactured the aroma chemicals inside. They are the largest manufacturer of these chemicals in India. Look at this map of their global footprint. They hold a massive 20% global market share. 1 out of every 5 products across North America, Europe, and the Middle East relies on their chemicals to function. This creates a difficult choice for your portfolio. Do you buy the stock because the underlying business operations are incredibly strong? Or do you avoid it completely because the current valuation is sitting dangerously high? Warren Buffett has a clear rule for exactly this scenario. He warns that paying an unfair price for a great company is one of the easiest ways to destroy your own wealth. To figure out if we are looking at a smart investment or a trap, we are going to run a reality check. We will separate the marketing promise of the company from the hard financial numbers. Buying blindly because a business is famous leaves you entirely exposed to market volatility. Accurately pricing the asset is your only true defense against sudden losses. Looking inside the company, the foundation is incredibly stable. The founders and promoters own over 60% of the shares, keeping their own wealth tied directly to the company's success, and the management team brings decades of specialized experience. This quadrant chart maps financial strength against valuation. They generate an excellent 19% return on equity and keep 22 cents of operating profit per dollar of sales. This 5-year trend line shows revenue growing 10% annually and net profit 11%. However, operating a physical chemical business at this scale requires a massive amount of working capital, and that creates a severe structural trade-off. Look at their inventory days metric, which currently sits at 246 days. After they manufacture a batch of chemicals, it sits in a warehouse for over 8 months before a customer actually pays for it. That right there is a massive red flag. While the profit margins look fantastic on an income statement, the reality is that a huge chunk of the company's cash is trapped in unsold barrels of liquid, creating a very real liquidity risk. As long as the global economy keeps buying, the system holds together. But if global demand suddenly drops, that bloated 8-month backlog of inventory instantly turns into a severe financial liability. Now we need to look at what the stock market is currently charging you to own a piece of these operations. To find the true underlying worth of the stock, we rely on Benjamin Graham's intrinsic value framework, known as the Graham number. Using the Graham formula, square root of 22.5 times an 82 rupee EPS and 341 rupee book value, we get a 796 rupee intrinsic value. Compared to the towering 2,935 rupee market price, the stock is 73% overvalued. The PEG ratio, which compares the stock price to the company's growth rate, sits at a highly elevated 3.25. A healthy, safe ratio is under 1.5, showing us the stock price has vastly outpaced the speed at which the company is actually growing. The high promoter holding and the 20% global market share are impressive facts. The problem is that the market has already factored all of those strengths into the current price tag. Buying at 2,935 rupees means you are paying up front for the next 3 years of absolutely flawless execution. If the management makes one mistake or the market slows down, there is zero room for error and your capital takes the hit. The long-term intrinsic valuation shows the stock is too expensive. Moving to the short-term technical chart shows the market is already beginning to correct that reality. This candlestick chart shows immediate downward pressure. PRIVISCL recently hit a 52-week peak of 3,440 rupees before dropping over 14%. The price action just broke below its 20-day moving average, confirming sellers control the tape. Looking at momentum, the MACD indicator has triggered a bearish crossover, providing a secondary mechanical confirmation that the buying power has been exhausted. Minor support levels at 2,836 and 2,700 rupees will likely fail under the selling pressure. The true high-probability support zone for a safe entry is the 200-day moving average, weighting down near 2,500 rupees. Trying to catch a falling knife just because the company's fundamentals look good on paper is a reliable way to get burned. The technical data perfectly mirrors the fundamental overvaluation. The stock is actively correcting back toward its fair price, meaning buyers need to step aside and let it fall. We have strong long-term fundamentals colliding with a terrible immediate valuation and a highly bearish chart. Here is a clear strategy to handle that data. This decision matrix breaks down exactly how to handle the stock. If you are a long-term value investor, your current action is to wait. Set a price alert for the 2400 to 2500 rupee zone and do not buy until the market brings the price to you. If you are a swing trader, do not execute a trade at the current 2935 level. The proper setup is an entry near 2550 rupees, a strict stop loss at 2380, and a take profit target at 3100 rupees. Executing the trade at 2550 gives you a highly favorable 1-to-3 risk-to-reward ratio. Entering right now at current prices ruins that math and exposes your capital to the downside. Success in this specific scenario requires emotional control. You have to ignore the fear of missing out and let the stock drift downward until it hits your required levels. PRIVISCL is a dominant manufacturer that generates consistent profits, but a great business only becomes a highly profitable investment when you purchase it at a mathematically sound price. Preserve your capital. Wait for the technical correction to finish its work, and enter the market only when the data confirms the odds are in your favor.